or wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets, so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week, so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 226, and in this episode we are reviewing the performance of the financial markets during the 33rd week of 2026, and that is from Monday the 17th to Friday the 21st of August. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off with a brief outlook for the global economy, where according to the International Monetary Fund, global economic growth is projected to slow down to 3% in 2026, tempered by geopolitical tensions in the Middle East and its impact on global energy prices that has elevated the outlook for inflation. Additionally, high sovereign debt is constraining government spending, and the back and forth trade tariffs continue to weigh down on cross-border trade. The only upside for the global economy is the performance of stock markets across the globe, and that is supported by massive investments in artificial intelligence. Over to the United States, where according to the minutes of the last policy meeting, which were released on Wednesday, Federal Reserve officials indicated that they would need to raise interest rates soon unless there was more progress made on bringing down inflation. During its last policy meeting that was held on the 28th and 29th of July, the Federal Open Market Committee voted 9-3 to keep the Fed funds rate targeted in a range of between 3.5% to 3.75%, where it has been throughout this year. This overnight borrowing rate serves as a guidepost for a variety of consumer debt, including mortgages, auto loans, and credit card debt. Those who voted against the decision favored a quarterly percentage point rate hike, and the minutes indicated that the dissenters judged that increasing rates now would help prevent the need for a steeper and potentially more costly sequence of rate hikes at a later stage. And over to China, where China's economy lost momentum across the board in July as consumer spending stalled and urban investment contracted at a faster pace, while unemployment ticked higher, adding to pressure on Beijing to step up support in the second half of 2026. According to the National Bureau of Statistics, retail sales recorded a weak growth of just 0.6% in July compared to the previous year, missing the Reuters poll estimate of 1.5% and slowing down from a growth of 1% in the previous month of June, and pointed to weaker domestic demand. Meanwhile, industrial output rose by 4.5% in July, slowing down from 5.3% in June, as the urban unemployment rate ticked up from 5% in June to 5.2% in July 2026. Over to the Far East, where Japan's economy expanded by 1.1% on an annualized basis in the second quarter, missing expectations for growth of 2% and compared to a growth of 2.1% in the first quarter as softer domestic demand offset strong exports. This is the first full quarter to include the impact of the Iran war, which has caused higher energy prices for both businesses and households. Exports were the main drivers of growth. However, this was helped by a weaker Japanese yen as opposed to higher volumes of shipments. And despite government subsidies, energy prices rose for the first time since November 2025. And in response, Japan's headline annual rate of inflation for the month of July increased to 1.9%, which was the highest level this year, driven by high energy costs due to the conflict in the Middle East. In the United Kingdom, according to the latest data, inflation in the UK increased by 2.9% in the 1 year to July, driven by higher energy bills, and was the highest rate in the past 4 months. According to data from the Office for National Statistics, gas prices increased at the sharpest pace in almost 4 years, and this was on the back of restricted global oil supplies due to the conflict in the Middle East, leading to an increase in the cap on household energy bills in the month of July. Experts reckon that this latest inflation report is unlikely to influence the Bank of England with regards to raising its benchmark interest rate at its next policy meeting in September. On Wall Street this past week, the S&P 500 rose on Friday as investors tried to find their footing following a steep sell-off driven by rising treasury yields. The financial sector also offered a boost to the broader market, with crypto-related stocks seeing sizable gains as Bitcoin posted a weekly advance of 22%. Wall Street was coming off a losing session as treasury yields resumed their march higher after the government's failed effort to hold back a sell-off in the treasury market. Bonds, particularly on the long end of the curve, have been under pressure on rising concerns about inflation due to higher oil prices. Thursday's pullback ultimately led the S&P 500 to tumble by 1.4% for the week, whilst the Nasdaq lost 2% during this period as both indices snapped a 3-week winning streak. Meanwhile, the Dow Jones Industrial Average slid by 0.9% for back-to-back weekly losses. And as Friday came to a close, the broad market index jumped by 0.43% to end at 7,674, whilst the Nasdaq Composite rose by 0.43% to 26,180, and the Dow Jones Industrial Average was up by 517 points, supported by gains in healthcare stocks, as the 30-stock index closed at 53,277. In the U.S. Treasury bond market, on Tuesday this week, long-dated Treasury yields hit their highest level in more than 2 decades amid a worsening U.S. fiscal situation and persistently higher inflation. The yield on the 30-year Treasury bond advanced by more than 4 basis points to hit 5.33%, reaching its highest level since 2007. According to figures released by the U.S. Department of Treasury this week, the U.S. national debt surpassed $40 trillion. The Treasury Department also reported that foreign holdings of U.S. Treasuries fell in June as the top holders, such as Japan, China, and the United Kingdom, have all been reducing their exposure to U.S. debt. And on Wednesday this week, the Treasury Department said it will more than double the size of its government debt repurchases, sending yields sharply lower at a time of substantial market stress. Under the accelerated buyback, the Treasury said it will at least double the maximum size of its buyback operations from $2 billion to at least $4 billion, starting on the 9th of September and running through to the 4th of November. And on Friday, the 21st of August, according to JP Morgan, the U.S. government's efforts to manage pressure in the Treasury market may merely shift the problem to the short end of the yield curve. James Sullivan, JP Morgan's core head of global fundamental research, told CNBC's Squawk Box that the approach of refinancing longer-term obligations with a shorter-term borrowing was comparable to paying your mortgage with your credit card. And towards the close on Friday, we saw the longer-dated U.S. government bond yields move higher as investors' concerns about the U.S. Treasury's extended debt repurchase program and the soaring national debt continued to hover over the markets. The yield on the short-dated 2-year Treasury note, which more closely tracks short-term Federal Reserve rate expectations, was higher by more than 4 basis points at 4.23%, whilst the yield on the 10-year U.S. Treasury bond, which is a key benchmark for mortgages, auto loans, and credit card debt, was up by more than 3 basis points at 4.73%. And at the far end of the yield curve, the yield on the 30-year Treasury bond, which was the main target of the buyback plan, rose more than 3 basis points to settle at 5.27%. Bond traders are now looking ahead to the Federal Reserve Chairman Kevin Warsh's upcoming speech at the Jackson Hole Economic Policy Symposium, where he could offer more insight on longer-term yields and the central bank's independence. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move inversely to one another. In the commodity markets, oil prices were little changed on Friday after Iran's president indicated that Tehran wants the war with the United States to end sooner rather than later. The Memorandum of Understanding, which the U.S. and Iran signed on the 17th of June, allowed Tehran to determine how the Strait of Hormuz would be administered through negotiations with Oman and other Gulf states. Crude oil prices have eased significantly over the first 2 weeks in August, as U.S. officials suggested a deal with Tehran was imminent in order to increase traffic through the strait. Oil prices finished the week more than 5% higher after Treasury Secretary Scott Bessent told CNBC on Thursday that Washington will impose the toughest sanctions in history against Iran. Brent crude added 61 cents on Friday to close at $94.39 per barrel, whilst the U.S. benchmark West Texas Intermediate crude rose by 23 cents to settle at $87.06 per barrel. In the precious metals market, gold climbed to more than a 3-month high on Friday and was on track for the third straight weekly gain, aided by a break above key technical levels as the Treasury's bond buyback program dragged down the US dollar. According to technical analysts, bullion was trading above all the key moving averages, having broken above the closely watched 200-day moving average, a move that technical analysts typically view as bullish. The dollar languished near its lowest level since mid-May as investors questioned whether the U.S. Treasury's efforts to calm the bond markets might end up undermining confidence in the currency. In response, gold gained about 5% this past week as the price of spot gold climbed 2.3% on Friday to settle at $4,619 per ounce. In the cryptocurrency market, Bitcoin rose by 6% on Friday and was on track for a weekly gain of 22%, following a spate of positive developments for the world's largest cryptocurrency. The rally began on Wednesday when Treasury yields pulled back sharply following the Treasury's bombshell intervention in the bond market, easing pressure on risk assets. This move helped trigger a broader move into crypto, which was later amplified by a massive short squeeze, with roughly $2.7 billion in crypto short positions liquidated, according to data from CoinGlass. Crypto-linked stocks rose, with Coinbase advancing by 8%, while Strategy was up by 6%. In summary, Bitcoin, which started the week at around $62,800 per coin, was on track for a weekly gain of about 22% before coming to a close at $76,900 per coin. Over to the African financial markets, where the Dangote refinery has announced that it has secured a $1 billion underwriting program for its planned stock market listing that could become Africa's largest IPO, marking a major step towards bringing the continent's biggest refinery to investors. For your information, in IPO transactions, underwriting is a service offered by capital firms and investment banks to a company in order to guarantee the sale of its shares to investors. The underwriting deal has two financial advisors, that is Marob Strategies from Dubai and Lilium Capital from the United States, who said on Tuesday that the underwriting comprises a fully funded $600 million tranche for the refinery's completed private placement and a further $400 million commitment to support the planned initial public offering. And just for your information, the Dangote refinery is reported to have submitted an IPO application for $5 billion to Nigeria's Securities and Exchange Commission. Staying in Nigeria, the Statistics Office reported on Monday that Nigeria's headline consumer inflation fell to 15.43% on an annual basis in the month of July, and this was down from 15.91% in June. Price pressures began accelerating in March after the US and Israel attacked Iran and triggered domestic fuel price hikes, snapping an 11-month run of easing price pressures in Africa's most populous country. Since then, the central bank has paused on interest rate cuts, saying caution was needed because of the uncertainty in the Middle East. The National Bureau of Statistics said that food inflation, which accounts for a large portion of the consumer inflation basket, accelerated to 20.31% in July, and this was up from 17.52% in the month of June. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenyan shilling remained stuck within a very narrow range versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.49, and this is compared to 129.40 the previous week. Meanwhile, the sterling pound was priced at 176.41 and the euro was valued at 151.07. And on the regional front, one Kenyan shilling was changing hands for 28.72 Ugandan shillings and 20.42 Tanzanian shillings. And to the Rwandese franc, it was posted at 11.35. Despite the ongoing conflict in the Middle East and the subsequent increase in oil prices, the Kenyan shilling continues to remain extremely stable versus the US dollar. The data shows the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. However, the central bank continues to insist that it operates a floating exchange rate policy with minimum interventions to smooth out extreme volatility. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 70% of ordinary revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves decreased by $90 million for a grand total of $15.15 billion, which is equivalent to 6.3 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. The recent increase in forex reserves was attributed to two main sources, the first being the receipt of funds from the sale of a 15% stake in Safaricom to Vodacom, and the second was the recent disbursement of $750 million from the World Bank that is aimed at economic and fiscal reforms. But despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024, with a maturity of Kenya's debut Eurobond for $2 billion. In the money markets, during the past week, the liquidity situation in the interbank market was sufficient to meet the demand for overnight lending, and this was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. Meanwhile, the overnight interbank rate, which is now referred to as the Kenyan shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the current central bank rate. And according to data from the Central Bank of Kenya, the following are the key short-term money market rates, with the latest data showing inflation in July coming out at 6.49%. Meanwhile, the benchmark 91-day Treasury bill rate was stable at 8.77%, and the average lending rate offered by commercial banks was recorded at 14.38%, whilst the average rate for a bank savings account was quoted at 3.32%. And in contrast, money market funds are offering returns of between 6% all the way to 10%. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 20th of August, and the central bank received bids totaling to 71.65 billion shillings against an advertised amount of 28 billion shillings, representing a performance rate of about 256%. The central bank accepted 57.5 billion shillings, and the results of the auction were as follows. The 91-day rate remained at the same level of 8.77%, whilst the 182-day rate was a tad bit lower at 8.94%, and the 364-day rate held steady at 9.03%. Over the past few weeks, the Treasury yield curve has been stabilizing with interest rates clustering around the 9% level. However, there is still the possibility of higher interest rates driven by increased government borrowing as the Treasury seeks to plug a budget deficit of about 1.2 trillion shillings for the current financial year 2026-2027. And in addition to that, the ongoing conflict in the Middle East continues to drive oil prices higher, which means that inflation will likely remain higher for much longer, and this will eventually feed into higher interest rates as the central bank endeavors to maintain price stability. As a consequence, we should therefore expect more upward pressure on interest rates as investors demand higher yields in order to offset the negative impact of inflation. In the corporate bond market, the Kenya Commercial Bank Group is targeting to raise 100 billion shillings by October 2026, this being the first tranche of a 5-year medium-term note program for a total of 300 billion shillings, setting the stage for what could be the largest capital mobilization initiative in the country. For your information, a medium-term note is a debt instrument used by corporations and financial institutions to raise capital, and it usually matures in 5 to 10 years and offers a middle ground between short and long-term debt. The 300 billion shilling program is the largest corporate debt program ever announced in Kenya and is achievable given the potential to raise funds in both local and foreign currencies. Kenya Commercial Bank plans to issue a combination of green, blue, and sustainable bonds as part of the fundraiser program, with proceeds targeted at projects and activities with environmental and social benefits. Up next is our topical issue, and this week we are looking at the World Bank caution to Kenyan commercial banks on rising sovereign debt risk. The World Bank has cautioned commercial banks in Kenya on the growing sovereign debt risk due to heavy investment in government securities, which has risen by about 150 billion shillings in the past 6 months. Sovereign debt is borrowing by a national government, usually through treasury bills and bonds, that is used to fund public investments and support economic growth. Sovereign debt carries the risk that a government may default on its financial obligations or impose regulations that negatively impact the duration and or the return initially promised on the government securities. The World Bank says that the exposure of commercial banks in Kenya to government debt remains high, with lenders holding approximately 2.2 trillion shillings in government securities, which is equivalent to about 35% of the domestic debt and about 27% of the total assets in the banking sector. According to the World Bank's latest economic update report for Kenya, the banking sector remains broadly stable, supported by strong liquidity and capital buffers. However, asset quality remains a key vulnerability as the ratio of gross non-performing loans reached 15.6% in March 2026. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them posted on the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, never bend your head. Always hold it high and look the world straight in the eye. A quote by Helen Keller. Think about it. Thank you, and God bless.